Welcome to today's Explainer. We're diving straight into what might be the biggest financial turnaround story unfolding right now in the data sector. We are talking about the massive revitalization of NIQ Global Intelligence. So who exactly is NIQ? Well, think of them as a true post-merger powerhouse, born from the strategic combination of Nielsen IQ and GfK. Together, they operate globally as the absolute definitive source of truth for the fast-moving consumer goods and tech durable sectors. And to really grasp their scale, you have to understand they aren't just out there fielding simple surveys. No, they are actively tracking trillions of individual data points across millions of retail stores worldwide. They act as this invisible analytical engine running right behind the biggest consumer brands you buy every single day. That invisible engine, it translates into a ridiculously lucrative, highly recurring revenue model. When we look at their 2025 revenue breakdown, the standout figure is the $3.39 billion generated from their intelligence unit alone. That's nearly 81% of their total revenue. This subscription-based foundation boasts a net dollar retention rate of 105%. Now, in the data sector, anything over 100% is the gold standard. It means not only are clients sticking around, but they're consistently expanding their contracts and spending more with NIQ year after year. The remaining $804 million is driven by their activation segment, which focuses on advanced analytics and AI insights.
Now, you might be wondering, why do these clients never leave? It all comes down to a massively wide economic moat, built on three pretty unshakable pillars. First up, we've got intangible assets. NIQ's historical database of those trillions of data points is virtually impossible for any new entrant to replicate. You simply cannot fake decades of historical context, right? Second, they benefit from incredibly high switching costs. FMCG giants completely rely on this data as their ultimate industry benchmark for reporting market share or even calculating internal executive compensation. Switching to a cheaper provider instantly breaks all your year-over-year comparables, and honestly, that's a headache that makes leaving fundamentally unviable. Finally, network effects create this beautiful, self-sustaining loop. Retailers share point-of-sale data with NIQ to get benchmarked analytics, which then expands NIQ's data pool, making it inherently more valuable to the brands.
This dominant moat really dictates their position within the $90 billion consumer market research industry. Look, they aren't the only players out there, but their specific omni-channel focus gives them a massive edge. Circana puts up a fierce fight, sure, but primarily within the US FMCG space. Kantar dominates consumer panels, but NIQ's unmatched global integration of FMCG, tech, and durables makes them the ultimate benchmark. They simply provide a broader, more definitive, and totally global view of consumer purchasing behavior than anyone else in the landscape.
But we've got to be objective here. There are absolutely secular headwinds to keep an eye on, specifically the disruption risk emerging from retailer media networks. Retail giants like Walmart Connect and Amazon Ads are increasingly monetizing their own massive closed-loop troves of first-party data, selling it directly to brands. If brands can get hyper-targeted data directly from the retailer, it could, over time, threaten their reliance on third-party aggregators like NIQ. You pair this with heavy margin pressure from top CPG clients who are currently in defensive, cost-cutting roads, and you've got genuine hurdles NIQ has to navigate to maintain pricing power during those big subscription renewals.
Wall Street actually really struggled to digest these risks at first, which led to a highly volatile journey for INEQ stock. Following their IPO in July 2025 at $21 a share, the market grew incredibly skeptical. Weighed down by post-buyout debt concerns, the stock just tanked, bottoming out in early 2026 at a dismal $7.93, ouch, right? But from that point of capitulation, the stock established a massive weekly rounding bottom, perfectly setting the stage for an explosive 17% gap up in August 2026.
So what triggered that aggressive high-volume gap up? Well, it was the ultimate turnaround catalyst, their Q2 2026 earnings report on August 11th. And this wasn't just a slight beat, it was a classic beat and raise scenario that forced a complete overnight recalibration of Wall Street's sentiment. Until that very morning, the broader market viewed NIQ as this sluggish, debt-burdened legacy data asset. But this single earnings call proved they were aggressively accelerating top-line growth, expanding margins, and basically executing a turnaround way faster than consensus estimates ever allowed for. The numbers driving that narrative shift? Honestly, they were staggering. Top-line revenue for Q2 alone hit $1.12 billion, representing an 8% year-over-year reported growth. The geographic breakdown was especially impressive, with the Americas segment acting as a huge growth engine, posting a blistering 12.1% growth rate. They didn't just inch past expectations either. Their adjusted EPS of 27 cents decisively crushed Wall Street's estimate of 21 cents. That is a massive signal of major operational leverage. But here's the metric that really matters for their long-term valuation multiplier: the explosive 34% growth rate in NIQ's AI-native revenue. This proves, without a doubt, that NIQ is actively and successfully transitioning its core product identity. They're evolving from a backward-looking historical dashboard, the kind that just tells a brand what sold last month, into a forward-looking predictive engine. They're utilizing machine learning to tell brands exactly what consumers are going to buy next month. And as we know, that predictive capability commands a much, much higher premium.
And this AI transition is already bearing fruit with major enterprise clients. NIQ just recently signed Purina as the first client for its Connect AI charter program. This is a huge deal because it demonstrates that this isn't just some theoretical pie-in-the-sky future product roadmap. Top-tier, multinational clients are actively buying into the immediate monetization power of NIQ's new AI tools right now, today. By integrating dynamic demand forecasting, major brands are clearly showing they're more than willing to pay up for a distinct competitive edge.
All of this top-line growth funnels down to the absolute most critical financial pivot of this entire turnaround: $74.1 million. That is the levered free cash flow generated in Q2 alone. To put the sheer magnitude of that into perspective, it represents an unbelievable $137.3 million positive swing from a negative cash flow position in the prior year. Literally, NIQ is finally printing cash. By aggressively implementing tech-enabled cost efficiencies, they slashed their cash data acquisition costs down to just 15% of revenue. And that pushed their adjusted EBITDA margins to a record 23.3%.
Now, that surging free cash flow directly addresses the massive elephant in the room: their balance sheet. Because they were born from a leveraged buyout, debt has basically always been the primary bear thesis here. But the rapid deleveraging trajectory is frankly undeniable at this point. In Q1, their net leverage ratio sat at a concerning 3.4 times. By Q2, they knocked it down to 3.1 times, and management is fully on track to hit their target of dropping below 3.0 times by year-end 2026. This aggressive, disciplined paydown actually just earned them a credit upgrade to B+ from S&P Global Ratings, which is going to further reduce their cost of capital.
We do have to talk about structural risks, though, particularly regarding the stock's float. While the underlying business operations are absolutely humming, legacy private equity backers, the firms that engineered the buyout prior to the IPO, still hold massive, concentrated stakes in the company. As lockup periods expire, we are highly likely to see secondary stock offerings. This private equity overhang means that even with stellar earnings execution, heavy block sales from insiders could create significant, albeit temporary, price resistance and volatility. It's just a mechanical headwind, but it's one that must be factored into any entry strategy. Taking all this into account, it's wild because the market is still really struggling to accurately price this asset. When you compare them to information services sector peers like Gartner or Verisk, the valuation disconnect is glaring. The sector average for forward price to sales sits at 3.5 times. NIQ is trading at a heavily discounted 1.1 times. On a forward PE basis, the sector commands a 22 multiple, while NIQ is lingering right around 15.1. Investors are clearly still hesitant, allowing those historical debt fears and gap on profitability to mask the underlying reality of their current cash flow generation.
The most telling metric, however, is enterprise value to EBIT, because it strips away all that balance sheet noise to reveal the true core operating value. Currently, NISQ is trading at approximately 7.8 times EV to forward EBITDA, compared to a sector average of 12.5 times. This massive multiple gap clearly indicates that the broader market is still pricing NISQ as a distressed asset. But as their expanding margins and rapidly accelerating AI revenue prove, they are quickly moving away from distress and straight towards sustained growth.
This massive mispricing creates a highly asymmetrical risk-reward profile for investors. In a worst-case bear scenario, let's say characterized by a widespread consumer goods recession, unexpected client churn, and macro interest rates straining their debt load, downside risk models place the stock back around $10. Conversely, the bull case is incredibly compelling. If those AI-native products continue driving growth above 8%, margins breach 26%, and the market finally re-rates them from a levered legacy vendor into a high-margin SaaS analytics platform, well, the fundamental valuation sits comfortably above $25 per share.
So how do you actually exploit this valuation disconnect? Well, a discounted cash flow model suggests a base case fair value of $22.50, which offers a roughly 35% margin of safety from recent levels. The actionable strategy here is a methodical three-step process. Step 1.
Accumulate shares in the $14.50 to $16.50 range, utilizing that recent post-earnings gap up as a definitive support zone. Step 2. Hold patiently, allowing management to execute the remainder of their deleveraging plan over the next few quarters. Step 3. Target that $22.50 fair value over the next 12 to 18 months as institutional sentiment shifts and the multiple naturally expands.
Which brings us to our final, overarching thought for this explainer. Trading at just 7.8 times EBITDA, printing absolute record free cash flow, and successfully executing a transition from a highly levered legacy asset into an AI-driven,